Hello and welcome to the Baird Trust Equity Income Fourth Quarter Portfolio Recap. My name is John Watkins and I'm a co-portfolio manager on the strategy. I will touch quickly on our recent performance and then make some comments about our long-term track record. In the quarter, our portfolio increased 13.2% gross of fees and 12.9% net of all fees, compared to the 12.4% increase for the Russell 1000 value and the 7.6% increase in the S&P 500. And for the full year 2022, our portfolio declined 10.7% gross and 11.9% net compared to the 7.5% decline in the Russell 1000 value and the 18.1% decline in the S&P 500. The bottom half of this slide shows the individual companies that were our top and bottom contributors for both the quarter and the 1 year period. You'll notice that especially for the full year period, there's a wide dispersion of individual stock price performance. Some were up double digits, some were down substantially. As we often say, a company's stock price is much more volatile than its underlying intrinsic value. That fact was put on display this year and really for much of the past 3 years. Our view is that short-term stock price movements do not tell us much about what is happening with the underlying business. For that, we looked at things like revenue growth, margin expansion or contraction, earnings, and free cash flow changes. In addition to the individual stocks listed here, the fact that we own nothing in the energy sector was a substantial performance headwind for the full year, detracting 3.5 percentage points from our relative performance. As noted in previous quarterly updates, we have been unable to find investment opportunities in the energy sector that meet our business, management, price, and dividend criteria. Now taking a step back to longer-term performance. First is performance over the last 3 years. We refer to this as the pandemic era, and it has been a wild ride. 2020 saw the onset of the pandemic, a 34% crash in the S&P 500 in a month, and emergency government intervention. This fueled a stock market rebound that culminated in rampant speculative activity in 2021 and ultimately led to another bear market in 2022. A lot happened in this compact time period. But over these 3 years, our equity income portfolio compounded at 9.6% annually gross of fees and 8.2% annually net of fees, which compares favorably to the Russell 1000 value's 6% annual return over that time period and the S&P 500's 7.7% annual return over that 3-year time period. And then zooming out further, the 5, 7, 10-year, and inception to date numbers are all ahead of the Russell 1000 value on both a gross and a net basis. On top of that, our equity income portfolio returns over this time period are only slightly behind the S&P 500 while providing substantially more income along the way and not being able to own some of the high-performing growthy companies that don't pay a dividend. So while this fact did cause us to underperform the S&P 500 in the strong bull market years, it also resulted in substantial outperformance in the most recent down year, 2022. So moving on, this slide shows our recent portfolio changes. In October, we made one change, trimming Genuine Parts, Paychex, and Pepsi, and initiating a new position in Parker Hannifin. Genuine Parts, Paychex, and Pepsi were some of the most expensive portfolio holdings on a price to intrinsic value basis at the time of the trims. So while we're still happy to own them, we believe it was prudent to redirect some capital from more expensive holdings into a new, attractively priced investment opportunity in Parker Hannifin. Parker is a diversified manufacturer of motion, flow, and process control components for the industrial and aerospace markets. Think sealants, adhesives, coatings, filters, couplings, and valves, among many other things. Importantly, Parker is an innovation leader, and most of their products are mission critical to their customer, which results in very sticky customer relationships. Parker has positioned itself around several long-term secular tailwinds that should fuel attractive growth for years to come. Additionally, we believe Parker's culture is unique in that it draws on its roots as a family business and is intensely focused on its customers. We have followed Parker Hannifin for many years, keeping tabs on developments in their business. Their recent acquisitions, combined with some share price weakness in 2022, gave us the opportunity to purchase shares at what we believe to be a very attractive price. On the left-hand side of this slide is the list of the 3 portfolio holdings that increased their dividend payments in Q4. While the fourth quarter is a relatively quiet one for dividend increases, I would note that 29 of our 33 portfolio companies increased their dividend in 2022, with 10 of these increases being in the double digits. The table on the right shows the dividend characteristics of our equity income portfolio compared to our benchmark, the Russell 1000 Value, as well as the S&P 500. As a reminder, 2 of our 3 portfolio objectives are to achieve a higher dividend yield and faster dividend growth than both of these indices. As you can see in this table, as of year-end, we are achieving these objectives over the long term. I would point out that the trailing 12-month dividend growth number is negatively impacted by T. Rowe Price's decision to pay a large special dividend in 2021, which hurt the year-over-year comparability. However, our portfolio has a current yield as well as long-term dividend growth track record that is superior to that of both indices. Unlike many dividend managers, we believe dividend growth is critical to our long-term success. Especially in today's world of elevated inflation, a stream of income that is growing rapidly is much more valuable than one that is growing slowly or staying flat. Finally, just a few big picture comments. 2022 was a painful year for investors. Stocks entered a bear market and finished the year down meaningfully. Bonds had one of the worst years on record. There was nowhere to hide. Unfortunately, as we know from studying market history, bad years like 2022 are inevitable. There aren't many positives to take from this past year. However, one silver lining is that the wildly speculative behavior that we saw for much of 2021 has been mostly eliminated. Excessive speculation can be very dangerous for investors, and this cleansing in 2022 should lead to healthier markets with fewer excesses in 2023 and beyond. Last year was also characterized by a substantial shift in Federal Reserve policy, with a sharp increase in interest rates to try to slow inflation. The rapid shift from loose monetary policy to tight monetary policy does have implications for 2023 and beyond. On the negative side, it will lead to economic headwinds. We don't know whether a recession will occur in the next year or 2, but it is clear that economic growth is slowing. On the positive side, the tighter monetary policy looks to be having its intended effect on inflation, which is trending in the right direction. So while we cannot predict the future, we do know it will contain some surprises that we aren't contemplating today. The last 3 years should serve as a reminder that the future is nearly impossible to predict. For this reason, we remain intensely focused on the disciplined execution of our time-tested investment process. We believe that advantaged businesses with talented leaders and attractive dividends can survive and thrive almost any environment, especially if purchased at compelling prices. That does it for our Q4 portfolio recap. We look forward to reporting our Q1 results to you in April. Thanks so much for your time.